Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk. I would like to do a quick video on how to start investing. I will drill more into the details in later videos, but this is intended to give you enough to be able to start, make some decisions, and understand the whole process if you are not investing right now. As I said in another video, it is important to take advantage of time and the compounding that occurs when you start investing early. You may think that you're not investing early, but sooner is always better than later. You should define your personal and investing goals. They should be written with measurable parameters. The acronym SMART for specific, measurable, attainable, relevant, and time-based. Brainstorm what you want in life. Do you want time? Financial independence? Do you want to travel? Do you just want happiness? Do you want cars? Do you want houses? Have a plan, post the goals, and know when you want them and why. If you have a financial advisor, he or she will help you do the following steps for you. Make sure your financial advisor is a good fit for you, and you should understand how he or she is paid. I will cover this in another video. Use budgeting, a previous video, to ensure you have the money available for any monthly asset purchases. Experts say you should be investing 20% of your gross income for retirement. This is if you want to retire in your 60s. So if you want to retire earlier or are saving for something else as well, make sure it works within your budget and make those adjustments prior to investing. Also, prior to investing, please have 3 to 6 months of basic expenses in an emergency fund. This is to avoid your having to sell your investment, perhaps after it's temporarily gone down in value, to live on if you were laid off or if your car needs a new transmission. Next, you can optionally choose an investing approach. The first one is the top-down. Have an investing thesis that ties everything together. For example, poor developing countries with low average age grow fastest as people are pulled out of poverty, they want to drink a Coke, drive a BMW, and play on their iPhone. Secondly, you can use a bottom-up approach, where you pick individual investments that will outperform the overall market with no theme, but you can have guidelines such as 20% in financials, no more than 10% in energy, etc. A good financial advisor will be able to cater to some or most of these requests and will help you define them. You also need to determine a risk profile. This will be another video, but you need to determine how much volatility you are able and willing to accept, which will affect the types of investments you make. Higher volatility generally means larger returns over the long run, while safe investments, think term deposits, don't return much. Determining your risk profile is one of your financial advisor's primary tasks, so he or she will help you with that. Otherwise, you have to do it yourself. Also, you need to decide on a portfolio vehicle, mutual funds versus exchange-traded funds versus individual stocks, depending on what you like, are familiar with, and whether you want the diversification and thus lower risk to be built in via the mutual fund or ETF, or decide to diversify manually using stocks. You will also need to pick an account type. The first choice is an RRSP, Registered Retirement Savings Plan. I will do another video about RRSPs and TFSAs, but a general guideline is to use RRSPs later in your career when you are in a higher tax bracket and you will get a bigger tax benefit for using up your RRSP limit to save on taxes. The TFSA, tax-free savings account, you would want to use early in your career when you are in a low tax bracket and pay little tax to have after-tax money to invest in the TFSA. And you're getting a tax break wouldn't be a big help yet. As you go up in tax brackets, use a TFSA only after an RRSP has been exhausted. You also have the choice of an RESP, so if you have a child, the government will match 20% of the first $2,500 contributed annually. So invest at least that much to get the free money. Then we have a non-registered cash account. If you've exhausted the registered accounts, or you expect capital losses, or you have Canadian companies that are eligible and pay Canadian dividends, this will be in another video about taxes. You can use a non-registered, also known as a cash account. Lastly, if you have bonds, you will want to have them in an RRSP or a TFSA, never in the non-registered account. I'll explain more in that taxation video. You will need to choose a discount brokerage. Money Sense usually does a comparison every year. I will post the link in the description below. Or, of course, if you have a financial advisor, then you just use the financial advisor's brokerage and you don't have to do anything else. If you are using your own discount brokerage, please check the annual fees for the various accounts, and especially for the ones that you've chosen. See what the minimum investments are for when the annual fees are forgiven. If there are any non-commission ETFs that the discount brokerage supports. Some brokerages allow you to buy stocks and ETFs for free, but charge a commission to sell. Mutual funds generally have no commissions to buy or sell. Otherwise, if you have a financial advisor, the advisor will guide you. Next, you will need to fill out the required forms, usually online or at the financial advisor's office, or send in a paper form with a void check to link the brokerage to your checking account for you to make purchases yourself, or to enable your financial advisor to make one-off purchases for you. You would also want to fill out a pre-authorized payment form for regular withdrawals to automate your investing. Monthly purchases will automatically be paid for using money drawn out of your checking account. Now it's time to pick the stocks, the ETFs, or mutual funds, depending on what vehicle you want to use for your investing, or your financial advisor will do so with you or for you. If you're going solo, you should use the Morningstar rating to begin your research, or let the financial advisor do it and just confirm they are picking good mutual funds or ETFs for you, and also within your risk comfort level. Transfer the money from your checking account to the trading account and buy the other assets as desired, or use the pre-authorized payments only that will automatically come out of your account. Now that you've made your one-time investment or are making the monthly payments, keep an eye on your investments, checking them periodically, but not obsessively, depending on how much you enjoy the practice. Once a year, it is a good idea to rebalance your portfolio. This is an activity where you determine if your portfolio is out of the 60% stocks and 40% bonds, for example, proportion that you and your advisor set up after doing the risk assessment. A good advisor will do this for you, but you'll have to do it yourself if you are self-directed. If your portfolio is out of balance, it has more or less risk than you want, and so you will want to sell and buy appropriately to get back to your comfort level. It also sells high and buys low as far as your portfolio is concerned. In this example, if stocks went up disproportionately, you sell them and buy bonds. And if bonds go up more than the stocks did as a percentage, you sell them and you buy the stocks. That concludes the quick overview of how to get started investing. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.